Welcome back. Tonight we're going to take a little bit of a different approach. We're going to look at technical analysis. Typically we focus on the macroeconomic numbers that go to make up our trends that we see in the charts, but ultimately we make our buy and sell decisions based on what the charts tell us. Well, the white line in front of us shows us the S&P 500. This goes back several years. The red and white histogram bars at the bottom show us to the depth at which the S&P 500 has hit a critical high or low. In other words, we see how far back in time we have to look in order to see a significant high or significant low of that magnitude. So, for example, we see here around September, October 2022, the S&P 500 hit a level 3600. We see a red histogram bar below that registers a level of around 500. So we have to go back about 500 days in order to see the S&P 500 hit a similar low, which occurred second quarter, third quarter 2020, about a year and a half, 2 years in that area. The white lines work the same way. So for example, if we go back very much back to around 2013, we see these white histogram bars hit a level of around 1300. The S&P 500 did not hit those significant highs for around 1300 days, so several years. The reason why this is important is because when we think about the markets in terms of the buy and sell pressure, once the stock market hits a new critical high or low, let's say a high, for example, in this case, it means that anybody that bought the stock market over the past couple of years they're all making money. Anybody who sold short the market is losing money. They're more likely to close their positions or margin call, stop loss, things of that nature. So we look to these levels to look for critical pivot points when the market may reverse or when it may in fact break out. So, for example, we see here more recently, the S&P 500 again is in white. The white histogram bars show us the potential breakouts or the critical highs that we've hit. Most recently, we saw the S&P 500 hit a critical high April 13th, just a few days ago. At that point, the S&P 500 hit a level of around 41 and change, 41.50. That's a level we haven't seen in about 40 days or so. About a month and a half. We have to go back to February around that level to see the S&P 500 at a most significant high. Prior to that, we look back to February 2nd. We hit a level of 116, which means when the S&P 500 hit that 4180 level, we have to go back about 116 days in order to see a more significant high. Now, generally speaking, if we go back to the longer term picture, we see there are trading ranges that develop. So for example, take a look at the white histogram bars. They all register highs around 100, 150 in that area, showing us that when the S&P 500 hits a level that it has not seen in about 150 days or so, it has a tendency to reverse. Conversely, take a look at the red histogram bars. When the S&P 500 hits a level of around, let's say, 400 to 500 level, most likely, at least according to this data, to reverse. Of course, there are exceptions. We look at the crash of 2020, the S&P 500 on March 23rd hit a level it had not seen in 860 days. Now, let's take a look at what we saw in 2007, because we all know those are very, very significant times. The S&P 500 was chugging along around 1500 or so, and it started to break down. Well, all of a sudden, on January 21st, 2008, the S&P 500 hit a low around 1300, 1310. At that point, the S&P 500 hit a level it had not seen in 326 days, about a year. It was about an average, it was about a yearly low. And obviously we saw what happened. The market hit a very significant low and eventually broke below 1200, which is a level the S&P 500 had not seen in over 500 days. That was on July 11th, 2008. So point being, the most significant lows that we see, if the market's able to break below that, it indicates the market's much more likely to spill to new very significant lows. And conversely, after hitting that very big bottom in March of 2009, S&P 500 turn around and we see this staircase of white histogram bars moving up, meaning every single day virtually we hit new highs we had not seen in, well, at least over a year or so. Now, this approach does not only apply to the stock market, we can also take a look at the bond market. But really quickly, let's make a mental note here. S&P 500 hit that very first critical low January 17th, 08. That was a 326-day low. Remember the number January 17th. We go back to the 1-year bond. Let's take a look first here. The 1-year bond in 2007, right here. We see the S&P 500 hit a low. Remember, the S&P 500 hit a low January 17th, roughly. Well, that was 08. April 24th, 2007, about 8 months prior to that, all of a sudden the 1-year bond hit a very big low. That was April 07. 8 months before the S&P 500 broke down, the 1-year bond was actually breaking to quite significant lows, around 100-day lows. Take a look at the 10-year bond during that period of time. The 10-year bond, that was September 07. Remember, the stock market broke down January of 08. Well, 4 months before the stock market sold off to that extent, the 10-year bond hit a low it had not seen in 188 days. Point being is that sometimes the bond market will move first and sometimes the stock market will move first. But we can see here that when one market moves and breaks to a new significant low, they're very much linked. So if one market breaks, there's a good chance another may follow. Take a look at the 1-month bonds. Now, this is present day. 1-month bond hit a very significant high. That's at 46.53. That means the 1-month bond has not seen these amount of highs in over 4,600 days. That's a very, very big high. Extremely historic highs. Now, of course, we know, we've spoken about the inverted bond market and how the 1-month bond has a highest yield of all the treasuries we see at one point. So it's really no surprise, but that really shows us the degree, how significant the strength is on the 1-month bond. The 1-year bond, present day, hit levels, let's see here, 4809, meaning in over 4,800 days on February 22nd, the 1-year bond had not seen more significant highs. What's interesting, we know the 1-month bond is making new highs, that the 1-year bond is making new highs. How about the 10-year? It's making new lows. The 10-year bond, most recently, April 6th, not too long ago, hit a level, a lowest low we have not seen in 151 days. So what does this tell us? And we've spoken about this during our inverted bond market recordings. In inverted bond market, the short-term bonds like the 1 year and the 1 month, they tend to go up, while the longer-term bonds like the 10-year, those yields tend to decline. Well, we see the severity of this inverted bond market, about 120 basis points at the moment. And if we look back in history, we know, go back in time to, let's say, for example, 2007, eventually the short-term bonds break down. May 1st, 2007, the 1-month bond hits a level it had not seen in 145 days. June 12th, 07, 175-day low. And that eventually led to an enormous sell-off we saw from 5% virtually down to 0%. So we know eventually if the stock market decides to go down that the 1-month bond will give us a very significant signal. And at least in 2007, the 1-month bond moved first. So we should watch the bond market to see what kind of moves it's making. Again, fast forward to present day, the 1-month bond is very, very strong, hitting very significant highs. The 1-year bond, very strong, making significant highs. The 10-year bond, not so much, but the signal to the downside is not the 10-year. If, on the other hand, we expect the market to break out to new highs, then historically what we see, and we'll go back to 07 to teach us that when we see the long-term bonds, when we see a market recovery, the long-term bonds move higher. So let's take this big level low of March '07. I'm sorry, '09. Stock market hits a very significant low. Well, December '08, the 10-year bond hit a very significant low and started to move higher. In fact, yields on the 10-year bond between December '08 and June '09, in 6 months, went from 2% to 4%. 10-year bond yields doubled in that amount of time. What did the 1-month bond do? Nothing. We hit those almost zero lows and we stayed at the bottom. So bull markets are led by long-term bonds. Bear markets are led by short-term bonds. Right now we see the opposite occurring. Short-term bonds like the 1-month are very strong. Long-term bonds like the 10-year are very weak, or relatively weak, I should say. And the S&P 500 is very much in a trading range at the moment. But going back to the stock markets, we look to the S&P 500. We've just seen a level that we have not seen in 42 days. Not a big deal. If we see the S&P 500 break above 4179, those were the highs of February 2nd. Well, then we'd see those highs at the moment were 116-day highs, plus, however much time has passed between early February and now. So, point being, let's look for these big significant turns or these big significant levels to gauge whether we're in the beginning of a new uptrend or downtrend. We'll look also to the bond market for confirmation of that. We hope this has been helpful. We look forward to seeing you back soon.